Chapter 1 Introduction to Accounting Standards. Before understanding accounting standards, first we learn about the meaning of generally accepted accounting standards. GAAP represents a standardized framework of accounting principles, standards, and procedures. Those must be there when preparing the financial statements. These guidelines ensure uniformity and transparency in financial reporting. So GAAP is a standardized framework which are there at the time of preparing the financial statements, which ensure uniformity and transparency in financial reporting. GAAP provides principles and standards and procedures how a transaction to be reported. So next, what is meant by accounting standards? Accounting standards are official guidelines issued by governments and regulatory authorities such as MCA, Ministry of Corporate Affairs, in collaboration with the National Financial Reporting Authority, NFRA. These standards govern the following aspects of financial reporting. What are the aspects? Recognition, measurement, presentation, and disclosure, which can be easily memorized with the hint of RMPD. R means recognition, M means measurement, P means presentation, D means disclosure. So accounting standard issued by governments in India, which is issued by MCA, Ministry of Corporate Affairs, in collaboration with NFRA, and each of the standards cover the following aspects. What are those aspects? Recognition, measurement, presentation, disclosure aspects. So what is the benefits of accounting standards? Standardization of accounting practice. Standardization of accounting practice helps reduce inconsistencies in financial reporting by ensuring the uniform accounting treatment. So accounting standards provide uniform accounting treatment. So we can reduce the inconsistency in reporting. Enhanced disclosure requirement. Mandate additional disclosure beyond statutory requirement, aiding stakeholders in understanding the financial data. Some of the accounting standards call detailed information to be shown in financial statement beyond statutory requirement. Even though if there is any statutory requirement to show a disclosure in the financial statement, the accounting standards call for that information to be shown in the financial statement for better understanding of stakeholders. It facilitates comparability, enable both intra-enterprises and inter-enterprises comparison, aid in decision making for investors and lenders. Because of uniform accounting treatment, we can compare intra-enterprises information as well as inter-enterprises information. So by comparing this information, the investor can make decisions. So these are the main three benefits of accounting standards. Next, the process of setting accounting standards in India. The Institute of Chartered Accountants of India, ICAI, established the Accounting Standard Board in 1977 to oversee the development of accounting standards. The process includes, what are the process? There is a 6 process. First process, identify the key areas needing standardization. Identify the key areas needing standardization. Next, forming a study group to draft a preliminary guidelines. Third step, circulating the draft to stakeholder. Circulating the draft to stakeholders like MCA, SEBI, C&AG, and CBDT for feedback. Seeking public opinions through exposure draft. Next, revising the draft based on comments received, issuing the final accounting standards. Other important point, for non-corporate entities, ICAI issues accounting standard, whereas for corporate entities, MCA, in consultation with the NFRA, National Financial Reporting Authority, finalize the applicable standards. Next, list of key accounting standards. The ICAI has introduced 29 accounting standards, but 2 of them removed So effectively there is a 27 accounting standards. Accounting standard 1, disclosure of accounting policies. 2, valuation of inventories. 3, cash flow statement. 4, contingencies and event occurring after balance sheet date. 5, net profit or loss for the period prior period items and changes in accounting policies. 7, construction contract. 6 is removed. 7, construction contract. 8 is removed. 9, revenue recognition. 10, property, plant and equipment. 11, the effect of changes in foreign exchange rates. 12, accounting for government grants. 13, accounting for investment. 14, accounting for amalgamation. 15, employee benefits. 16, borrowing costs. 17, segment reporting. 18, related party disclosure. 19, leases. 20, earning per share. 21, consolidated financial statements. 22, accounting for taxes on income. 23, accounting for investment in associate in consolidated financial statement. 24, discontinuing operation. 25, interim financial reporting. 26, intangible assets. 27, financial reporting of interest in joint ventures. 28, impairment of assets. 29, provisions, contingent liabilities and contingent assets. So next, accounting standard have to be read in line with the legal requirement. That is, in case of any conflict, the statute would prevail over accounting standard. The standards cannot override law and local regulations. So law will prevail over and above accounting standards. So next topic, the need for global accounting standards convergence. Several factors necessitate aligning the Indian accounting standard with the international standards. Access to global capital market. Companies raising fund internationally must comply with the following regulations. Improved financial statement comparability. International investors require standardized financial data for evaluations. Third, enhanced transparency and uniformity. Harmonized standards improve the trust in India in financial reporting and cross-border investment opportunities. If the Indian company want to raise fund internationally and international investors require standardized and international investors want to invest their money to Indian companies, they all needed a standard which should be in the line with the global standards. So these factors necessitate aligning Indian accounting standard with the international standards. Same set of standards improve trust financial reporting and cross-border investment opportunities. If Indian accounting standards are in line with international standards, it will improve the transparency and uniformity. So these factors necessitate Indian accounting standard with the international standards. Next, International Accounting Standards Board and IFRS. The International Accounting Standard Committee was established to develop international accounting standards, which later evolved into International Financial Reporting Standards under the International Accounting Standard Board. IFRS comprises of IFRS issued by International Accounting Standard Board and also IAS, International Accounting Standard issued by International Accounting Standard Committee. So IFRS comprises IFRS issued by IASB and also IAS issued by IASC, International Accounting Standard Committee. Indian accounting standards are almost similar to IFRS, but with few caveats and as to make them suitable for Indian environment. Indian economic are different from other countries' economic situation. Because of that, it is very much important to create a somewhat similar Indian accounting standard that bit almost similar to IFRS. Any country can become IFRS compliant either by adoption process or by convergence process. Indian accounting standards are converged IFRS accounting standards. Convergence with the IFRS will result in the following benefits. Improved investor confidence across the world with the transparency and comparability. It improves the transparency and comparability of investors across the world. Improve inter-unit, inter-firm, inter-industry comparison. Group consolidation will be easy with the same standard by all companies in group irrespective of the global location. Because of using the same set of accounting standard, company can easily consolidate irrespective of their global location. Accessibility of financial statement by stock exchange across the globe. Acceptability of financial statement by the stock exchange across the globe, which will facilitate listing of Indian companies to international stock exchange. Cross-border flow of money help investor in decision making, low risk of error. Then what is meant by curves and curves in Indian accounting standards? The government of India, in collaboration with or in consultation with the ICAI, opted for convergence with IFRS instead of adoption. This decision was made after a thorough evaluation of IFRS requirement and extensive consultation with the various stakeholders. During the formulations of Indian accounting standards, significant efforts were undertaken to align these standards closely possible with their IFRS counterparts while considering the India's unique economic landscape. So Indian economic situations are different from other countries' economic situations. So we created our own Indian accounting standard that aligned as much as possible with the IFRS. So what is meant by curves? This refers to deviations from the IFRS principles and practices due to economic differences between India and other countries. Carvings, these include additional guidelines incorporated in Indian accounting standard that extended beyond the provision of IFRS to better suit India's financial environments. So carvings mean additional guidelines that incorporated to Indian accounting standard beyond IFRS provisions. Carve-outs mean the deviations of IFRS principles because of Indian economic differences with the other countries. So Indian accounting standards are IFRS and we made some modifications upon IFRS. Complete convergence would require the adoptions of IFRS in its original form as issued by IASB, International Accounting Standard Board, in consultation with the MCA, decided to implement two distinct sets of accounting standards, Indian Accounting Standard and existing accounting standards. So Indian accounting standards. Indian accounting standards refers to the IFRS converged accounting standards implemented by the Government of India. These standards are developed under the oversight of the Accounting Standard Board of ICAI in collaboration or in consultation with the NEFRA, National Financial Reporting Authority. The MCA, Ministry of Corporate Affairs, finalize and enforces the applicable accounting standard for companies in India based on the NEFRA's recommendations. So what are the benefits of Indian accounting standard? It provides transparency of financial statement and comparability of financial statement, enhance the disclosure requirement, and it provides globalization and liberalization. These all are the benefits of Indian accounting standards.